Hello, friends. Welcome back to another session of High Five. This is Michael Long from the Kaplan CFP staff faculty. I hope your studies are going well. I hope you're building some momentum, and I'm pleased to know that you're tuning into High Five as one of your study resources, as you would see there on your 10-week study planner. And by staying so close to that study planner, it will assure that you use the key resources such as High Five as part of your plan in the way that they're designed to be a comprehensive approach to your exam prep. So I'm thrilled that you are taking the time to listen in on this particular session. Today we're going to focus on topics from income tax planning, which would be, of course, in your review book number 4. And we've done some other sessions. I hope you have the time to listen to those as well. If anything that I talk about today creates a question for you, I would sure hope you would send that in either to me directly, michael.long@kaplan.com, or through your instructor link service that you have on your dashboard. If you do that, just make sure you put High Five in the subject line, so they'll route that question directly to me. If this is your first session that you're listening to, High Five's a little bit different in that it's very casual. I'm simply sharing my desktop with you, and I have pulled some pages from the 6 review books that have some elements that make for good test material, because there are certain nuances within the topic, and some of them absolutely are known to be in the national exam on a fairly frequent basis. I never know exactly which ones, of course, you're going to see on your day for the exam, but the feedback we get is many of the things we work with here in High Five are helpful for the questions you see on the national exam. And the whole purpose of this, I always say, is to help you cross that bridge from academic knowledge to financial planning application. That can be one of the hardest things for folks to do with this exam, because every exam we've ever taken professionally, even college perhaps, has been an academic recall exam. CFP is not. They force us to know how to apply the academic knowledge to a financial planning scenario. But it takes a little practice to climb that bridge, and then you get over the hump and you're on your way down and racing to the finish line. And then my little reminder, as I say in every session, have you read the standards of professional conduct at least once this week? I sure hope so. I did a special High Five session just on the standards of professional conduct, but in that session I advise that you download the standards and make it a practice to try to read them once a week. They're just so critical for the national exam, and a source of many questions in the exam. So I'll continue to remind you in subsequent sessions as well, but let's get on with this. We're going to look at some things from book 4 today, and I always have the disclaimer here. Just keep remembering that all 72 topics, principal topics from the CFP board list, are fair game for this exam. Don't feel that the only topics that you'll see on the exam are the ones that I talk about in High Five, because that will not be the case. It's all fair game, which is why you must diligently study very comprehensively. And as far as these books go, that means read them cover to cover. Hopefully more than once is always my wish, but at least once, and make notes or flashcards and highlights. Stop and study the application examples that are embedded throughout the sections of the book. Do every practice question that is in the book, and there's some good higher difficulty questions in the back of those books called domain questions that are primarily focused on the steps in the financial planning process, of which there's questions like that on the national exam. So this is not a supplement. Not a replacement, it's a supplement to those books, and hopefully you'll take my advice on that and just really stay diligent with your reading. All right, so there's the list of topics from CFP board that are in the income tax section, and I just want to comment here on the 12%. I think that 12% is what I call good old 1040 testing. It's the basics of income tax, and it will feel like that for sure. But income tax, I may have mentioned this before, it's one of those topics that threads its way really through all 6 of your base courses and your 6 review books. We talked about the taxation of investment products in a session. We talked about the taxation of insurance products. We talked about the taxation of education funding products in another session. So don't be surprised if you come out of the exam thinking that was way more than 12%, because it may feel like that. You may have had an investment insurance or education question that was focused on the taxation but was categorized as an insurance or education question, not from this particular section. So it's everything you need is in there though, and income tax is one of those subjects. Most CFP students are not already CPAs, so this doesn't come as easily to a lot of us as it would for a CPA. But remember, with income tax, it's one of those subjects that your first mission is to grasp the most fundamental or basic application of the topic or strategy or service that we're talking about. Don't feel like you have to absorb 10 layers of detail to have any chance with these questions on the exam. Quite often your knowledge of the basic application will get you the points. There's a lot of foundation information in this material, but focus on what I always say is that low-hanging fruit. And then as you progress with your studies and you do more reading, you do more questions, you do case studies, in live review you're back with a top instructor to review some key points again, you will just naturally absorb more details as you go through this. But High Five is a good session just to kind of focus on the highly testable elements of a topic that I'm sharing with you, but don't panic if some of it is kind of foreign. I wanted to make a note here at the bottom of this, charitable contributions and deductions. There is a nice section for that in book 4. I am going to talk about that section with the estate planning session because I'm going to talk about charitable trusts in that session. So I just thought that'd be a good place to add the charitable contributions as well. But we will get into that in that session. So where I want to start, I hope this helps you too, because I really believe it really helped me for the national exam. Was one of the things I did was download and print out a copy of Form 1040 and Schedule A for itemized deductions. Now there's other forms that can be helpful to you, and these forms are also copied in the books. I just found it powerful to have the form from the IRS on my desk and handy when I was studying income tax, because I thought it was pretty powerful to be able to locate on those documents, where does this happen? Where does this item of income get included? Where does a deduction happen? Where does a tax credit happen? And then what I experienced with the exam was when I ran into those kinds of questions, I kind of could picture the front and back or page 1 and page 2 of the 1040 and say, okay, I know where that lands, so that's a deduction for AGI or from AGI. So give that a shot, if you will, and see if that helps you just kind of solidify your understanding of where certain tax pieces take place. So what I'd like to do first here, I'm going to open a 1040 that I just have here on my desktop. Just to demonstrate what I'm talking about here. So if we scroll down here, just to see the order as we start to enter income items, so you can see the whole lineup of things that roll up into total income on line 22. And then below that, we're going to start taking things away from that income. So you've got your obvious pieces there of wages and salary and interest and dividends and such. But I highlighted line 11, alimony received. And I'll touch on this again in a moment. But there are multiple questions in the exam question pool about alimony. And one is just the simple fact that alimony paid is deductible to the payor, and alimony received is taxable to the payee. And that could be one of the standalone questions, is just how is that treated? And they may throw in child support into that same question, and child support is not deductible and it's not taxable to the payee. So expect a combination type question. You also see there on 13 where you would enter a capital gain or a loss. And it's not common with a lot of these elements in this section where you would also enter a loss. But you do for this piece of it. So you could see a question where you do capital gain netting, and then just know that that netted amount comes here. And these are all rolling up for AGI is really what I'm getting to. You see the other common items there as far as IRA and pension distributions. I stopped on line 20 with Social Security. Here is where that gets entered on line 20. And then the taxable portion, if any, is entered on line 20B. That's one of the, there are questions in the national exam pool about the taxation of Social Security. And this is where that would happen. Then we start taking things away. When we get into the adjusted gross income section, lines 23 to 37 is where all this happens. So the items here, if you look at 23 through 35, those are all deductions from that total income we rolled up into line 22. And you could see a question that uses deductions for AGI. And just know that they're talking about these deductions that happen straight up from total income on the first page, on the front side of the 1040. There's some other important pieces here that could be standalone exam questions. Line 27, I would expect a question, and I'm going to touch on this today, about self-employment tax. You could have a question where you have to calculate it. You might have to understand that part of that is deductible. Essentially, the employer share is deductible. It would also come into play, that deductible portion, in a retirement calculation in determining the maximum contribution a self-employed person could make to a retirement qualified retirement plan on their own behalf. So that's kind of an important line to understand how self-employment tax works. This is also, as you see on 28, where contributions to a SEP, simple or qualified plan would happen, as well as self-employed health insurance deduction. Line 31, I should have highlighted that as well. That's where the deduction is for alimony paid, as well as IRA, student loan deduction, student loan interest deduction. So we roll all those up, subtract them from that total income, and now we have AGI, adjusted gross income. And as you know from your studies, a lot of thresholds in the tax and retirement elements are driven by AGI, and a lot of them have their own modified adjusted gross income, MAGI. And it can be unique, like for Social Security, MAGI for Social Security includes even tax-exempt interest that we would have entered on this 1040, but it wouldn't be taxable. You see up there in line 8B, we enter the tax-exempt interest, but it's not added to the taxable amount. Well, it counts for AGI when determining taxation of Social Security, which I'll talk about in the retirement session for High 5. So that's the front side of it. And then if we flip it over to page 2, we get into deductions from AGI. So the whole for AGI and from AGI is one of those RTFQ, read the full question pieces to make sure, what are they asking me? Because if it's for, we're adding to income, or we're taking deductions from the total income to arrive at AGI. If it's from AGI, that's already been determined, of course, and now these are all the things that come off of it. Starting with very obvious things that we're all familiar with, of course, itemized deductions from Schedule A, or at least the standard deduction, which is always a given, and that's in your tax tables as well. Exemptions, of course, we put those on this backside, and then come up to taxable income. That's the first math we do in subtracting these from AGI deductions. And then we calculate the tax on 44. So using the brackets, and the brackets are in your tax tables. I'm going to talk about them in a minute. We come up with the tax. And then 45, I'm going to speak about AMT. And you just need to know here that that's a secondary calculation. And if the amount of tax calculated under AMT is more than what it was calculated under regular income tax, this is where the difference gets entered to add to as an additional tax. So it would be the excess of the AMT amount over the regular amount, then we would add that into line 45. Then there's a real important section here, and that is tax credits. Now these are the non-refundable tax credits. And you know from your studies that non-refundable mean that the tax credit itself cannot create a refund. The best it's going to do, and that's indicated on line 56, when you add up these refundable tax credits, non-refundable tax credits, if line 54 is more than line 47, enter 0, because it's not going to take it below 0 when you're using non-refundable. And then we have other taxes. If there's self-employment tax, there's a line up there. I don't see a lot of exam questions in there, and so I haven't highlighted anything, but that's where it happens. And then we start getting into the tax payments, and this is where the refundable tax credits come into play. And one I've highlighted here is AOTC, American Opportunity Tax Credit. That actually could have an entry on line 50 in the non-refundable portion, but also there could be a portion on line 68, and that's because 40% of the AOTC credit that's calculated based on eligible expenses, 40% of that could actually be a refundable tax credit. So that's a nice little one-off question about AOTC, is whether it's refundable or non-refundable, and it could be some of both. So the maximum, we'll look at this in a minute as well, but we have a maximum tax credit for AOTC of $2,500, so 40% of that would be the maximum refundable portion. Is not going to be more than $1,000. Now, important to connect with refundable tax credits is the red box note there is, if you look at the section that it's in, tax credits are treated just like the other tax payments the client has made, notably what was withheld from earnings, line 64, or any estimated tax payments, quarterly estimates that were made on line 65. Well, your refundable tax credits are in that same category. That's why they can create a refund. If you look at what the client has already paid or had withheld, and then you add to that mix refundable tax credits, it's possible that when you total that and look at the total tax on line 63, we've got a refund. So there are questions in the pool about that, and there's some really good practice questions in the Kaplan material to look at non-refundable and refundable and whether they can create a refund or not. But this just always helped me, like, okay, I know where that is. That's one of the payments, the refundable tax credits. And this also shows, if you think about it, that a tax credit is far more advantageous than just a deduction from income. Because if you think about it, the credit is a dollar for dollar reduction of the actual tax owed. Whereas those deductions, let's say back on the 4 AGI category on the front page, that's just reducing the income. So the actual tax savings then of those reductions for AGI is just the marginal bracket times that amount. It's not a dollar for dollar reduction of the actual tax payable. So you could be asked an exam question, conceptually how this could be tested is you've got some information, and in that information you see what they owe in taxes, and then there's a list of different kinds of credits. So if you know just even a short list of the most obvious pieces, and those are in your book. If you look in review book 4, you'll see the more common tax credits that we're talking about here. You need to think that through and what combination of non-refundable and refundable could be taken. And that's particularly true. And I think this is a highly likely question where you're analyzing the education tax credits. I mentioned that, I think, a little bit in the, what would that have been, the general principles session of High Five. But it's real common to have an exam question with a family and they have multiple family members in school with eligible education expenses, and you're asked to sort out the combination of tax credits to take. You know, should you use lifetime learning credit, which is a non-refundable tax credit that would go up there on line 50, or should you, and that's a family amount, right? We talked about that in the other session, whereas the AOTC is refundable to a certain extent, to that 40% amount. So you've got to look at, all right, what combination are we going to use here that would give the client the best tax situation? The big picture on that is just use up the non-refundables, and hopefully that chips the tax due down to a low enough amount that then when you can apply the refundable ones, we're creating a nice refund. So don't be surprised if you run into that particular question. The other thing I wanted to look at real quick at the top here is Schedule A. This is another one that I recommend printing out. And all these have instructions too. So if you're really struggling with an item, don't forget that you can also get the instructions for these forms and see if that helps connect for you. Nearly everything that you're going to be tested on is just going to be in the book, but sometimes when you're struggling, if you just have a mental block with this tax stuff, it's good to get some IRS material going. So I just want to point out a couple of things here. Eligible medical expenses. Note that here there's multiple things that go into this, but it is subject to a threshold. If this is tested, you're most likely to be tested on the 10%. And then just try to remember what it used to be, 7.5. That now applies if the folks are 65 or older. But if you're tested on that percentage, it's probably going to be the 10% number. So it's subject to a threshold. It's not that all these are just flat out deductible. The deductible part or the includable part for itemized deductions is the excess over 10% of their adjusted gross income. So keep that in mind. And then I made another side note here that you know, the general understanding of tax qualified long-term care insurance is, oh, the premiums are deductible. Well, not dollar for dollar. Tax qualified long-term care insurance premiums to the specific limits, and I doubt that you'll be tested on the exact limit, premium limit that can be includable for 2017. I doubt that you'll be tested on that, but it is an eligible medical expense. It's in this category. So up to that stated limit, it goes in with these other eligible expenses. But how much of it ends up getting deducted is subject to this threshold. So don't be fooled by a question that would go down that path and basically stating that tax qualified long-term care premiums are fully deductible. That may not be the case here, right? All right, the other thing, pretty obvious, state and local taxes, property taxes, home mortgage interest, which is often the biggest deduction here. Charitable gifts, that's where it happens. But notice none of those have the threshold applied like that first one, medical expenses. And then the last piece down here, 21, line 21 through 24, are miscellaneous itemized deductions. It won't get way out in the weeds on this. If you're curious, if you're just interested in what the other category is, IRS publication 529 has a whole list of other things, but I don't think an extensive list would ever make its way into a test question. It would be the big picture thing, unreimbursed employee expenses, tax prep fees. And then this one is another one with the threshold. This is subject to a 2% threshold. So only the expenses in excess of 2% of AGI is going to be deductible. And there it says, enter the amount on 25, enter the amount from Form 1040, line 38. That's your AGI. And then we have the 2% threshold. I highlighted these because those are often testable areas. Do you know which itemized deductions are subject to an AGI threshold? So it's the first items in medical, the last items here in job expenses and other miscellaneous are both subject to the threshold. So if you haven't studied with the actual forms printed out, try it and see if it helps you connect with any more of these topics that you might be struggling with. But by all means, send in the questions, because this is one of them that seems to be a challenge for a lot of students. So send them in and we'll help you. All right, what I want to start with here are the provided tax tables. Now, I'm disappointed. CFP board they can be really slow at getting the current exam cycle pages posted. So I thought about leaving this section out, but then I thought, no, what I'm going to talk about in these tables is not so much the actual numbers, but conceptually how they get tested and what to watch for. So I went ahead and left it in, and it certainly will be updated before you sit for your exam. But I think I've been after them. Hey, when you open the registration for the exam, you ought to put out your tax tables for that cycle because we need them. So just know that this will get updated and you'll have plenty of time. But also remember the things that would need updating on this page, it's just the numbers. So you're not going to be memorizing them. Just know what's there when you need them for a particular question. So with that, the first thing that I highlighted is just the first set of tax tables are the marginal income tax brackets. So you can see the graduation, the progressive nature of the marginal bracket. And remember, a simple question on this would be, what does it mean? What is meant by one's marginal income tax bracket? And you probably know that, well, that's the percentage at which the next dollar of taxable income would be taxed. When you look at one's tax return and you look at their total income and the total tax that they pay on the backside of the 1040, it's, they may be in a 28% marginal bracket, but you look at those two numbers and the tax for the year and the gross income, it's not 28%, and that's because this is always the next dollar. So that should be an easy, if you happen to land on that one, what is meant by a marginal bracket. And then this also drives, I'll talk in a minute, we're looking to the marginal brackets to see what long-term capital gain tax rate it would be. And again, these will all be updated for you. I've never heard, certainly never saw one myself, never heard on the exam that you would have to go in and calculate the tax based on adding up the income, taking away deductions, coming to a taxable amount, taking away tax credits, and then going and say, okay, what would their actual tax be on that result? I've never heard of that. The marginal brackets and things are used for other purposes and questions. So the net investment income tax, that's fairly new, but I was very pleasantly surprised that they have just included that in these tax tables. And I might add that they've really expanded these tax tables. There's a lot more information in these than there ever used to be. So that just translates for you to be far less things that you need to memorize, which is a big reason why you want to print these, study with them, so that you'll know what you don't have to memorize. And then just as important, you'll know where in the document it exists. Now, it won't be a printout. It won't be a hard copy tax tables. It will be a tab on the screen on your computer-based testing, but you can access it anytime. It's always up there, and you can open it and look at these same tax tables. But just get used to knowing what's in there and where is it in the particular pages so you can get there quickly. So the net investment income tax, remember here, this one applies on investment income. A question for this might throw in some a bonus from work, or even salary would be pretty obvious, but a bonus or some other element of earnings. Wages, compensation could be in there. What we're looking for here is the list of investment income, and that rate is 3.8% of the amount over the threshold. Now this one has an interesting nuance, and I think this is maybe why they're giving it to us, is that there can be questions where you have to know it's the lesser of. This tax applies to the lesser of the net investment income or the excess of modified adjusted gross income over these thresholds. So if you just happen to see both, remember it's that lesser of, or come back here and check this, because it could be either one of those numbers as the correct answer. Because our instinct would be in a hurry, would be just to look at the investment income and take 3.8% of it and say, that's my answer, because that probably will be one of the answers often offered. So be careful and come check that first. The additional Medicare tax, now remember this is pertaining to wages. The other surtax, and they used to call the 3.8 an additional Medicare tax, but they don't anymore. It's net investment income tax. Medicare, this is applicable to wages, and you get the threshold. Although I must say, I haven't had anybody come back and say, hey, yeah, there was a question on there, you had to calculate it. But I always think if they're taking the time to put something in the tax tables, that sooner or later it's going to show up and be used in a question. So one of the reasons I highlighted the marginal tax brackets is, as you know from your studies or personal experience, that's what drives the maximum long-term capital gain tax rate. And you can see here in the 10 or 15% ordinary marginal bracket, it's 0 and so forth. Most of them are there in the 15%. But beware of a question. If it's going down this road, what would be the maximum long-term? Make sure they haven't thrown something into the question that increases their marginal income tax bracket. And that's where you would flip back to those tax tables and say, where are we at this income level? Okay, yes, they're in a 28% bracket. But if in that question narrative there's something that would put it into the next category of 33, just beware of that and know where to get your information very, very quickly. Because they certainly, if they show you that it's at a 28, or maybe just tell you it's 28, but then go on to talk about these other income items, pushing it to 33, our instinct would be, oh, it's going to be 15%. Or 0 or whatever. Just be careful with that. Estates, again, I don't think you're going to have questions. We're going to talk about this in the estate planning high five session, but I don't think, again, you'll apply these brackets, but just note a couple of things because this could narrow answer choices. Look how little income it takes. Now, here we're talking about income generated by the trust itself. The assets are in the trust. There are assets in there generating income. Look how little income it takes to get to the top bracket. It only takes $12,400 of taxable income in the trust to reach 39.6. So how that impacts is whether to use a trust and hold money and be generating that income. So you'd need to measure that, okay, what's the most tax efficient way for them to do that? So it could disqualify the trust answer choice based on the story, of course, but just be sensitive to the fact that it just does not take too much income to get to the top brackets. So here's something a lot of folks that don't look at the tax tables end up spending time memorizing and writing out. And then they get in here and think, oh, I wasted some time then. And remember, these are all 2016, and your review books have already been updated, and but these will be updated as well by the time you're ready. And then there have been some questions in the past that throw in the fact that the taxpayers over age 65 or blind or both. So I point that out here. Just know that that's in this section, and you know to add to the standard deduction if they fit one or both of those special additional amounts. All right, I'm going to get into, I thought I would just stick with the tax tables and cover the things that are about retirement as well, rather than come back to this another time. And a lot of them are tax aspects, but this was one of the additions. I think it was only about maybe a year ago, maybe just 2 cycles ago, that they expanded the tax tables and put in a lot of retirement information. There used to be very little, and now there's a lot. So that was a great relief. Starting with elective deferrals at $18,000 and a catch-up of 6. Remember, that's an aggregate. See, they have the elective deferrals there, 401k, 403b, 457, SARCEPs. Those all have the same amount, but the 457 deferrals do not get aggregated with the other. So a common question is, they have a 401k and a 403b. What is the maximum they could defer between the two plans? Well, it's aggregately 18,000. It's not 18,000 per plan, unless that other plan is a section 457 plan. Then they could go full out in the 401k of 18 and 18 into the 457. That's a great exam question, and is a common way they test the 457 knowledge. The annual additions limit, this is one of them that has changed for the new year. And that applies, you'll learn in the retirement segment what makes up the annual additions limit. And we have 2 things here. Your defined contribution plans work off of an annual additions limit, but the defined benefit pension plans work off of a maximum benefit that's funded for. So we get a lot of email about that, with students being confused about which ones are subject to annual additions and which ones are subject to just an overall benefit limit. And the most common mistake is students want to apply the annual additions limit to any kind of plan, and it just doesn't work that way. The simples, of course, have lower deferral limits. And that would count. I think their tables, they should actually reference that with the simples, that things that are being deferred into a simple would count against those collective limits. In the formulas for benefits, there is a maximum compensation that can be considered in the formula. The pension formula, profit sharing contribution formula, all of that cannot be based on a limit of greater than, well, in 2016 it was 265, in 2017 I think it's 270. So remember, that's another one that really gets confusing, particularly with questions pertaining to defined benefit pension plans, because they may know that that piece we just went through, the 210 as it was in 2016, that's the benefit limit. But then we see this other piece of 265. It's like, what does all this mean? Well, it means that the most compensation that could be included in 2016 was $265,000 for the pension formula. But even with that, the benefit currently being funded for could not be greater than 210. That's how those two work together, but it creates a lot of questions from students. IRA limits, you know those, but here was a great relief. The phase outs, those used to never be provided either, and these get, these get pretty confusing. So, and here, remember with the traditional IRA, I will revisit this in the Book 5 retirement planning session. But with the traditional IRA, the phase out thresholds that are shown to us is the deductibility piece. It doesn't limit how much they could contribute, the $5,500 limit. They could contribute that as long as they have compensation of at least $5,500. The issue becomes how much of it's deductible for their taxes as a deduction for AGI, right, from the 1040. So you see your thresholds there, and then it's possible for a partial phase out, and we get some questions about that. How do you do that? And it's real simple. You just create a fraction, and the numerator is the amount of magi in excess of the lower threshold end. And then the denominator for that is the total threshold spread. So if we just look at the married filing jointly threshold, 98 to 118 in 2016, it went up a little bit for 2017. So the total spread is what? It's $20,000. So if in the question narrative we're told that their magi is 108, our fraction becomes 10,000 divided by the full spread, 20,000. So half of the contribution deduction would be phased out. So in that scenario, on a $5,500 contribution, of course, $2,750 is deductible, $2,750 is not. Really simple math, and it has shown up before. They had to do that partial phase out. And then contrast that to the Roth, of course, and again, they have to have compensation to be eligible to contribute, but we're not talking, of course, about a deduction here. It's just the ability to contribute at all. Same limit, $5,500, but they may not be able to make a full $5,500 contribution. But the phase out would apply the same way that I just went through. Exact same structure for the fraction. Going to get into the estate piece of it. We'll revisit this, but just remember what numbers are in the tax tables. Applicable credit or unified credit versus the applicable exclusion amount. You'll see in the Book 6 piece where we take this apart, but they're one and the same. The credit in 2016 of 2.1 million represents the amount of tax that estate tax that would be payable on a taxable estate of 5.45 million. They're not. We get email a lot that students are trying to apply both of them. That first they take out the 5.45 million and then later they deduct the 2.1. No, it actually happens in the credit side of it. But so you know how to do the taxes. If you look at the estate tax brackets and look at the marginal progression on 5.45 million, then you could calculate that for yourself. It would be 2.12 million. And then know the difference with for ongoing gifts, annual gift tax exclusion, that $14,000 amount. Don't confuse that with any kind of credit. This is effectively the amount of gift that could be excluded each year to an individual donee. And then, of course, we'll see in Book 6, when we split gifts, then we can bump that to 28. So keep that stuff straight. You will have numerous questions about Social Security, and again, your book is updated there for the limits. But this is a ripe area for questions because there's so many ways to come at it. Just in this tax piece and in benefits piece, we could have questions that deal with the reduction in retirement benefits for one claiming retirement prior to their full retirement age. We could have a question that has reduction of benefits because one, they've retired, they've claimed prior to full retirement age, and they have earned income exceeding the thresholds that you see there, so they could see a benefit reduction. And the third piece is taxation of benefits. So any one of those, or you could maybe deal with, I don't know that you'll see a question where you have to deal with all three of those in one, but certainly you could deal with one that has two of those three elements in it. And they used to not have these thresholds in here. So prior to full retirement age, there's a threshold of $15,720, and if the AGI is above that, well, there's a special modified adjusted gross income for Social Security taxation purposes or benefit reduction. So if we're above that 15.7 in earned income, then there can be a benefit reduction of $1 of benefits for every $2 over the threshold. And then in the year of full retirement age, if the earned income is greater than 41.8, it expands greatly, doesn't it? Because here we're looking at full retirement. The threshold goes from 15.7 to 41.8, and the reduction goes from $1 for every 2 to $1 for every 3 over the threshold. And then beyond full retirement age, there's no reduction. They can have an unlimited amount of earned income, and it's not going to affect these formulas at all. And on this question, if they throw this one at you, again, remember, you don't have to memorize these thresholds or anything. They're going to be there for you. But be careful on this one. When we're talking about benefit reduction due to earned income, in that question, they inevitably throw some unearned income into the narrative as well. So you may be led to think that they're far more over the threshold because they've thrown in the unearned income. And again, I'm going to revisit some of this. I'm just introducing you to what else in the tax table so you'll know. You don't have to memorize all this stuff. This has been interesting to me. To my knowledge, there hasn't been a question where it gets into actually calculating the exact full retirement age based on these years of birth. This is the table as it would appear with Social Security, like at SSA.gov, let's say. But I suppose you could. I just haven't heard of it yet. Usually if it gets into this area for testing, it's someone whose full retirement age is 67. and then it may be about these reductions that we just went through. So at a minimum, the low-hanging fruit here is just know what happens if the full retirement age is 67, and that happens for anyone born in 1960 and later. 67 with a maximum reduction of 30% if they retired at age 62 instead of age 67. At least know that piece of it and be comfortable with it. And let me know if you see something that was far more sophisticated than that, as far as having to figure out, was it 66 and 2 months or whatever. Health savings accounts, you'll have at a minimum 1 or 2 questions about HSAs. And I keep expecting one day we're going to have even more, because they put a lot of information out there. So understand how this all works. To be eligible to make deductible contributions to an HSA, things have to happen, right? One, the insured has to have a high deductible plan. And on their 2016 tables, that was for a single 1,300 or a family 26. The deductible has to at least be that high. So that's your first cut on that question, is do they qualify with the deductible size? It could be higher than that, but it can't be lower. But that higher deductible is going to come into play really in the administration of the next one, the maximum out-of-pocket limits. And that in 2016 was $6,550 and $31,100. So if they had a $2,000 deductible for the single, that's fine, but that means that for that single, only another $4,550 of out-of-pocket could happen in the plan through the co-payments and so forth. So keep that straight. We get a lot of questions in the application of these two different things about the deductible and the out-of-pocket limit. And then you have HSA contribution maximums will be there for you, and they are adjusted on an ongoing basis. But what's interesting about the HSAs in the note box there is it's one of the very few things that the IRS will allow a double dip tax benefit. They won't let us do that with any of that education business. We can't use the same eligible education expenses to claim multiple tax benefits, but you can in the HSA. If they meet all the other requirements, the contributions are deductible, and that's a deduction for AGI on that front side. And the double dip is that if the distributions are used for qualified medical expenses, the distributions are tax-free. It is so rare to have the ability to do that double dip. So you see the contributions here, and then one of the things to make note of as it relates to HSAs, and I want you to go read about this, but it's something called the last month rule. Last month rule, and that's in your that actually might be in book 2. I don't remember off the top of my head whether they cover it again in book 4. So you may need to look in both. But anyway, that last month rule just says that if the taxpayer is available on in the last month of the tax year, and for CFP exam purposes, that's going to be January through December. So if they're eligible by December, for contribution purposes, they are considered to have been eligible the whole year. So one of the questions that's likely in this is they'll give you that scenario, and they'll say that maybe they became eligible November 1st or October 1st. How much can they contribute to the HSA for the current tax year? Our instinct is, okay, they're in there 3 months, so I have to divide this limit by 12 and multiply it by 3 or 2 or whatever the month was. Not true. You can put the whole amount. Now there's some other things that have to happen. They have to maintain the plan for a period of time, or there's some recovery. I don't think that's the test question. The test question is, do you know about the last month rule? So take a look at that and get comfortable. I think you're likely to see it. Also then, this is one of those things, 1040 deduction without itemizing. If you think about that, on the itemized deduction, Schedule A, that first piece is medical expenses, right? Long-term care insurance premiums up to the limit. Well, if you were with me on that 1040, the HSA, that's not on Schedule A, it's on the 1040 deduction for AGI. So that's another benefit of the HSA. You can also do a one-time funding distribution from an IRA to the HSA. It's one time only, and it is subject to the limit, of course, but that could be a nice narrative where they're describing the eligibility and need, and you can look up all the maximums and everything, but then they're struggling to fund it. But in the narrative or in the case study, there's this old IRA that maybe they're not going to do anything with. Well, that could possibly be the source of some funding there. Distributions to pay long-term care premiums, distributions to pay COBRA coverage. So just a really nice host of benefits that they can become the funding source for. That's what makes it so rich for multiple questions, but I would guess you'll have at least one. AMT, I'm going to get into that in a moment, but here just know that your thresholds and your rates are given. I don't know if the actual calculations have shown up yet on the exam. The phase outs were not always given. So it's another one of those things, at some point they may show up. Most likely it'll be conceptual of just how AMT works, and I'm going to talk about that. Another tax credit here for child tax credit, and this is not a big one, $1,000 per eligible child, but there is a phase out on it, and that's where the thresholds are. The maximum credit is reduced $50 for every 1,000 over the MAGI threshold. So they do put a note there that just says it's it's phased out when the income is 20,000 over the threshold per child. All right, went through all of the different education pieces in the in the general principles of financial planning, high five. But here again, here's all your numbers. So you don't have to memorize these. But now this is a change. They used to actually for Coverdale, Lifetime Learning, and AOTC, they actually then told how it was structured. So now you have to remember that though. So for the AOTC, the maximum credit is, I meant to put 2,500 there, I see. I did, AOTC 25 requires $4,000 of eligible expenses, and the breakdown is 100% of the first 2,000, 25% of the next two, and 40%, as I mentioned on the 1040 piece, 40% of the credit could be refundable. Backing up then to Lifetime Learning, the max there is 2,000, and it takes 10,000 of eligible expenses to reach the maximum of $2,000. But here again, be expected to play with that math and what combination of these tax benefits would you recommend that's best for the client. We're going to use up the non-refundable, get into the refundable, and hopefully create a refund. All right, that's a lot of stuff, but that's a lot of test points you can grab right off of those provided tables. Getting into book 4 here, then I think you'll have to do this. And this, what page of the book are we on here? 31, 32. Just calculating the self-employment tax. And there you see that expanded wage-based limit of $127,200 in 2017, but it's unlimited for the Medicare side. So what we're working on here, the things we're looking to spot in the questionnaire, what was the net income from self-employment? That's how they started out. And then we go to work on this. And the reason I wanted to stop on this page is because the most common mistake we see with this self-employment tax calculation is students forgetting to multiply the net earnings from self-employment by 0.9235. What they have a tendency to do is get right into the 15.3 on the net earnings from self-employment number for getting this step, and that's why I highlighted it today. Then this can also impact, this gets back to what is the deductible part of Social Security for AGI. That was another one of the highlights I made on the 1040. So we would do this calculation, take half of it, half of that can go on the, which I've always equated to the employer share of that tax, goes on deduction for AGI, but it also plays a role in determining the maximum contribution a self-employed person could make to a qualified retirement plan. We're going to go through that in the retirement session, but it does impact it here. We have to take that deductible portion away before we would apply the contribution percentage for the retirement plan. There is a shortcut, and I'm sure your live review instructors will get into this, but when the earnings are less than the wage base, so in 2017 less than the 127, what was it, 127.2, you could apply this shortcut. Just take your 0.9235 times the 15.3 self-employment tax and multiply the income shown by 1.1413. A lot of folks use that. I never did. I just did the whole math so I never would forget it, taking the net earnings from self-employment by 0.9235, then by the 15.3, and then all you would do now, if you see it's above that limit, is add to that 1.45, I'm sorry, 2.9 on the full amount. It's not limited to the 127.2. So I think you'll do this. I really do. I suppose it could be either way, earnings above the threshold or earnings below, but it's pretty easy calculation as long as you remember the 0.9235. Here's the, I mentioned alimony and looking at the 1040, so here's the section in the book that gets into that. Taxable to the payee, the receiver of the alimony, it's deductible to the payor. Now, another question that's out there is, how much could this particular person contribute to an IRA? And the setup is they may not have any wages from employment, but they're getting this alimony. Well, for IRA purposes, the alimony counts. So don't be fooled by that question if they're giving you an alimony figure. All right, AMT. AMT is one of those where, your eyes cross pretty quickly. I showed you on the 1040 where it comes into play. Just think of it as we're calculating taxes for regular income tax, and then we turn around and we do another calculation with many of the deductions eliminated, and then we have a new exemption and different tax rates, and we compare the two. And if the AMT is higher than the regular, then we're going to need to take the difference and add it to the tax on the back side of the 1040. No big deal. I'm going to try to point out some of the more likely things that would be testable with this. So you've got all those numbers. Don't worry about those. They're going to be in your handout. Quick little formula, and this is something that a lot of folks will practice by writing on a flash card or a scratch pad of some type. But the first cut on this is not trying to separate out, in my opinion, the adjustments and the preference items. Most everything you would see in a test question on this is going to get added back. So to separate them as preference and positive adjustment, that's great. And I think by the time you're done with live review, because they too are going to talk about AMT, you'll absorb more of those details. But on first cut, just understand the structure. AMT calculation starts where the regular left off, but we're going to start backing out some things. And I've just highlighted the stuff that I think is easy to remember. When you think about what's allowed for regular income tax and what's disallowed for AMT, exemptions are easy to remember. Standard deduction is easy. Itemized, they tweak it. State income taxes and property taxes, that can be a big one, right? That's an easy one to remember. And then the miscellaneous piece. So it gets into some more finer detail, and maybe you'll end up remembering 1 or 2 or 3 more of those. But I like your chances of getting this question right if you just remember those highlighted pieces. So don't feel the pressure of knowing every single thing on these tables. Now, one of the potentially the biggest item on here, and that's why they like to throw it into a question for AMT purposes, the exercise of incentive stock options. At exercise, if you remember from your studies, there's no regular income tax event, is there? But there is a positive adjustment for AMT purposes for that bargain element, which you remember is the difference between the fair market value at the time of exercise and the strike price and the exercise price. That's the bargain element. That gets added back for AMT purposes. So think about that. They exercise $100,000 of ISOs. Well, you could have a huge add back here that ends up being a lot of AMT above the regular tax, and we're adding that back in on the 1040. So that's popular. That one shows up a lot in the AMT questions. And I may have mentioned in the insurance and employee benefits session, there's a really good item set on in book 7. It's item set 16 in the case study book. In the case study book, in the front you have, I think, a dozen case studies followed by 35, I think, item sets or problem sets, and then 3 or 4 mini cases. Well, item set 16 is often how ISOs and non-qualified stock options get tested. Years ago on my exam, and I mentioned this in the other session, I thought they had taken the question right out of Kaplan's book. It was so exact, and I got excited because I knew I was getting it right. But check that out if you're not quite comfortable with the taxation on the ISOs. But just take a look at this short list, and in a short amount of time, you could start to remember that lineup of things that gets added back in. The things that are on that tax return, plus then come down here to ISOs and add it in. And when you see the term positive, because you could get a conceptual question, what's it mean? What's it mean to be a positive adjustment? Well, that doesn't mean it's a good thing. It means an addition, positive as in addition, when a tax preference item is always positive. That has been a standalone question. But as far as memorizing which or which, I just try it, but feel good if you're getting the rest of it and don't get into these deeper details on this. All right, another source of great questions, passive activity and at-risk rules, another subject that will cross your eyes very, very quickly. So I want to give you some low-hanging fruit on this. You're likely to have a couple of questions probably that lay out for you the passive activity, how much was invested, and how much loss it spun off in a given year. It won't get much more complicated than that, but you have to know how it gets applied. In that question narrative, they will also tell you how much, if any, passive income that the client has. So you're just picking off the variables, and then you can apply the rules. And one of the most confusing pieces from the questions we get from students is this application of the at-risk rules or the passive activity loss rules limit. I wish they would label that second one passive activity income rules. So At risk just simply means that they're never going to be able to deduct more than what they have invested, what they have at risk. And you can read on and maybe absorb some more details about how to add or subtract from an at-risk amount. But more importantly, that's usually a given. You know what that amount is. So that's one cut. And then the second one is passive losses can only be deducted against passive income. So you could have a situation where either one of those or both of those rules causes the loss to not be able to take in any given year. It would have to move into a later time. That's all this is about in this kind of question. So if you roll on down through here, you can start to see some examples of suspended at the at-risk rules. So right away, I'm a big one, and maybe I've said this to you before, I'm a big one to read the last sentence of a test question first, just to hopefully isolate what really is being tested after their little story and its twists and turns and all the variables they've listed. It just helped me isolate the noise. So if I would see at the end of a test question, you know, how much of the loss can they claim in the current year? Well, right off the bat here, if this were structured as a question, I see Bob invested $50,000. That's my at-risk amount. So no matter what, it's not going to get any bigger than that of what he can claim. And what I say here, $75,000 was his share of the loss for the year in question. So that could stop it or limit it. We would automatically not be able to do more than 50,000, right? And 25,000 would be suspended under the at-risk rule. But then there's a secondary limitation to this. When we talk about the deduction or the loss can only be applied against passive income. And that's why we want to be able to spot what they tell us about passive income for the year, because we could change this example into another question, and Bob has 50,000 at risk, but he has no passive income. So nothing's happening this year, is it? Because that piece of it would get suspended under the passive loss rules, or what I call the passive income rules. So break that down into simple, you know, practice on your flashcard. What does it mean? What's the at-risk piece mean? What does the passive loss rule mean? And then you'll have some nice practice questions to apply this. But that will often get you the points. Just knowing how those two get applied will get you the points on the exam. Now, I had made a note up here I want to come back and mention, because a lot of times we get questions where they're confusing the order of what gets applied first, because you're being asked, you know, what portion would be suspended under at-risk or passive loss. I think this one's easy to remember just by using those first letters. At-risk, A for at, P for passive. The letter A comes before the letter P in the alphabet. Therefore, I remember the order just that at-risk comes before the passive loss. But that's a great source of questions where they get really confused under which rule are they suspending the loss. This piece of the book goes on to talk about the other forms of income. You have three pots, basically: active income, portfolio income, and passive income. And I've just boxed out that key point that passive losses are only deducted against passive income. I point that out because it's not uncommon in this particular question. They will give you a sum of each. You'll see the passive income, you'll see active income. They may not call it active, they may call it salary or commissions or something. Or they may call the portfolio by just dividends or capital gains. You just have to be able to reach in there and pull out the passive piece to see how much you might be able to deduct. This used to be a very abusive area of the tax system you could really take advantage of, and in the early days of this, folks were actually able to deduct multiples of what they had invested. And so these rules really were to curtail that, and for the most part they have. Now, I don't know how high probability this box is on this page, but I just want to draw your attention to it just in case. If you see something referred to as a publicly traded partnership or master limited partnership, the nuance here that would put it in my question pool is that if this is the investment, then losses can only be used to offset income from that very same publicly traded partnership. Whereas on the previous page, you're kind of rolling up all of the passive income. This one is very specific. It's just from that, and I think that makes it a good one-off question, but I don't know whether you'll see it or not. If I had to bet, I would say it would be the previous pages. But just file that one away, MLP. And then there is, I think this is highly likely too, there's an exception for real estate activities. And don't be confused here if they're describing a full-time professional real estate agent. That's not what this is about. This is just for the casual rental property investor. There's a special rule here, and I boxed that out for you. This one's been on the test a lot. That's why I put the star here. The non-real estate professional can deduct up to $25,000 of rental real estate losses against active and portfolio income. Now there's some tests. I don't think that's where the test question is though. I think it's just applying, knowing one, that this is available, and then how that 25,000 works, because there's a phase out of the 25,000, and this has been tested a lot too. And so all this is it's a $1 reduction in the maximum 25,000 offset for every $2 of AGI in excess of 100,000. So you might need to apply that in a question. It really has been on there a lot. So given that we've highlighted it today, I hope you do see it and you know how to apply that and understand. Often there's a partial phase out in the question, so you need to know this $1 for every 2 AGI over 100,000. All right, that's a lot of stuff. I appreciate you hanging with me through this session. And again, like I opened with, don't be intimidated by this. You know, I unfortunately I had heard a sad story from a student who took the exam recently and didn't pass. So we were talking about it, and in the conversation it came out, he said, man, that tax stuff just blows me away. I don't know a lot about it, and I can't concentrate on it very long. So for every tax question I saw in the exam, I just marked C and moved on. Well, there's just no way we're going to pass the exam if that's how we're handling it. So be courageous and dive into this stuff that's uncomfortable. Seek to grab that low-hanging fruit and understand the most basic application. And just imagine it that, you know, I'm sitting in your office and we're going through that list of 72 questions, and hopefully you could just tell me one thing. What's one thing you know about this topic? So, you know, what do you know about AMT? Well, it's a secondary tax system, and most of the deductions people take are taken out of that, and then the taxes recalculate. Great. Maybe I can't tell you much more than that, but I got a shot. I've got a shot at the question, so don't be intimidated. As I've always mentioned, if you have questions on this or any other topic, feel free to send them to me, particularly for High Five, send them directly to me. But as you're reading your content and studying and doing questions, please use that instructor link, ask an instructor service on the website. That opens a dialogue for you with, in most cases, the author of the material you're looking at. And that's pretty high-level access if you think about it. And use those folks on an ongoing basis. Help them help you by giving them your thought process. If most of the questions that come in are about practice questions or case study questions or something, help them by telling them how you formulated your answer. That was incorrect, and they might be able to spot where you got disconnected. But you probably didn't have much need for that service in your required education courses because that's at the basic level. So particularly if you've never used it, now's the time to start incorporating that into your ongoing studies, because we would love to help you. As I've said before, there's a long-time service, very dedicated team of folks behind you with one mission, and that's we're all here to help you pass this exam. So please take us up on it. All right, thanks for listening in today. I hope you listened to the whole series in total, but keep studying. You totally can do it. This is a very passable exam, but you just need to do the work. All right, take care. Hope to see you next time. Thanks now. Bye.